It could. We've had three major crises for Facebook: Cambridge Analytica, political pullbacks, boycotts last year, and now this. And so the stock is certainly has shown resilience with the three things that matters: users, advertisers, and employees. Whether that still all holds up under this latest barrage of negative sentiment and negative news, whether that holds up or not, it's hard to know. I think it will. I think as we go through this, and as the company disclosed its internal research, I think the findings turn out to be a little bit more nuanced than the toxic headlines first indicated. I frankly think that research, when you just look at the slides yourself, I think you come away with it with the belief that these platforms are influential, but they're not flat out negative, and there's a lot of positive elements to them. So we'll see whether that plays out. I have yet to see signs that advertisers or users are disengaging from the platform. If we were to see that, that would change it. I just think this is one of the highest quality assets in mega cap. The ability to sustain 20% growth, highly profitable, tons of cash, some good long-term vision, very good execution track record, and now it's trading at one turn above its trough multiple. You can buy this at 18 times earnings, a discount to the market. So I think a lot of this risk is priced in.
What about as we go into earnings season, Mark, the companies that you're a little bit worried about? We touched on Amazon last week, but Peloton I see pops up in that list ahead of earnings season.
Yeah, and I'll still make that point on Facebook. The one thing to watch out for, I think the numbers are fine for this quarter. I think it's a low bar quarter. It's the expense guide for next year. Facebook's a little bit out of the norm in that they'll give next year forward expense growth forecast. It's actually a smart thing. I think more companies should do that. Anyway, my guess is that they're going to guide to expense growth higher than where the street currently is. So you could first see a knock to earnings. I think the market would buy that any sort of greater contraction than you've already seen, correction than you've already seen in the shares. But that would be a numbers risk. And then Peloton, that's a name where we're a little bit concerned with some of the new products that have rolled out, that street gross margins and EBITDA loss or earnings loss, EBITDA losses are going to be a little bit greater than what's in street numbers. So that's something that keeps us on the sidelines near term. And then we still have some long-term questions on the stock, but we certainly think it's worth monitoring. Let me put it that way.
Yeah, it's already gotten hit pretty hard in recent weeks. The Nasdaq's out 6% from the highs. Communication services as a group down 8% from the highs. I would think it's a more favorable setup for earnings, Mark, overall for some of these tech names. Usually they come into it at the highs.
You're right. We've had, and what's been the major deflator? It's been rising interest rates. Fundamentally, 1.5, 1.6%, yields are pretty darn low, but it's the rise that people have been concerned about. And that's a tough call to make. There's a lot of factors that will go into that. So if you think that there's an aggressive interest rate rising environment, yes, that's going to limit the ability of tech to outperform. But I think the market is first going to move towards the highest quality tech names. And in the space I look at, consumer internet, I mean, there's very clear 3 or 4 champions when it comes to high quality businesses, generate lots of free cash flow, et cetera. Amazon, Google, and Facebook. So in the extent that the market's going to pull back from tech, I think the first names that the market would come back to would be those 3.